Okay, welcome. First thing I want to clear up, apparently there was another holdover from 621 that implied that next week we're not having class, but that was from 621 when we had Memorial Day off. So there is class next week. All right, so that's out of the way. Okay, tonight we're going to talk about time value of money and the valuation of bonds. Now, this chapter, this time value of money, we're going to use it to do the chapter on the bonds. We're going to use it when we talk about investing in capital projects. So this is a very essential foundation for chapters to come. Now, the basic premise is that a dollar today is more valuable than a dollar received in the future. In other words, if somebody were to say to you, come to work for me today and I'll pay your salary at the end of the year, you'd say, well, wait a minute, that money that you're paying me is, I'd rather have something now than to get it 12 months from now. And the reason is that a dollar can be invested to make more dollars. We can use it to purchase goods and services. And the element of doubt or risk, when we talk about finance, risk is an outcome that we didn't anticipate that impacts our earnings. Okay, so having the dollar in my hand, I eliminate that risk of receiving it. Okay, so if you know your required rate of return, in other words, what do I want from my investments, okay, and the length of time before the cash is received, you can calculate some critical metrics. And the two basic, the value today of a payment to be received in the future is present value. And present value calculations are the cornerstone of finance, okay? But we can also calculate future value, and future value is something that we're much more familiar with. Okay, and here's what I mean. All of us have gone to the bank and put money in the bank, and a year later, we have more money than we started, okay? In other words, what they're saying here is we invested $10,000 into an account that paid 5%, and after a year, the money grew to $10,500. In other words, it's $10,000 plus the 5% interest, or $500. Okay? Now, this mathematical calculation can be boiled down to future value equals the investment, and your author calls it cash at time 0 multiplied by 1 minus the rate. Okay? Now, what I want to do, Matt, could you call up the... all right, now, in Excel, Matt, could you put the cursor over the 10,500? Okay. And then hit function here. Hit the function.
All right.
Up on the... yeah, there we go. Okay, now, like you're doing the homework in Connect. What I'm going to do is show you how to do things in Excel to check yourself. And I stress that if you turn in something like tonight's go live or anything that has to be turned in, you use the Excel. Trust me, the technology today is so much better than what we had in the 60s and the 70s that you should take advantage of it. Now, there's a function. If you go up to the function bar and hit financial, one of the functions that are there is future value. And the arguments that it's looking for is the rate, the number of periods, in this case it was 1 period, and the present value. Now, you'll have to ask Bill Gates this, but for some reason, when you use this, present value has to be entered as a negative to get a positive result. Okay? And again, if you turn in work with a negative amount, you know, you will not get the proper score. You won't get full credit. Don't ask me why, but all through tonight's examples, I will tell you. And by the way, this is up in Engage, so refer to it because the problems you're doing tonight use this formula sheet, and it's up in Engage, so make use of it. All right.
Can you just tell me again where on Excel this comes up under?
All right. What you do is you go to Function.
Okay.
All right, and the drop-down menu will come down, and it'll say what type of functions do you want, and you choose Financial. All right, so you hit the function key. You get a drop-down menu. It'll say what type of functions do you want. You hit Financial, and then they're alphabetical. So FV, and again, this is guys. I used to use something called I can't even think of it now. It was invented by engineers, and it was on a timeshare. I mean, it was so crude 30, 40 years ago. Now, in Excel, you can do all this stuff, and I would imagine if you're going to be in finance, you're going to run into this. Okay, so again, it's looking for the rate, the number of periods, and the present value, but you have to enter it as a negative. All right? Then if you click OK, there you go. There's the 10,500. Okay? All right, now, the reason I bring up the fact, we'll go back to the slides, this idea that we're all familiar with putting money in the bank and having it grow over time, okay? All right, now, this same formula can also be used to derive present value. In other words, if the future value equals the cost, the investment at time 0 times 1 plus the rate, then the present value is the future value, all right, the investment a year from now, divided by 1 plus the rate. Okay? So you buy in, if you believe the future value calculation, then you have to buy into this. Okay? Now, some textbooks would have just used future value, FV here. Your author is simply saying C1 is the cash received a year from now. Okay. Now, this, as I was getting ready for tonight, what this is saying is, suppose you were promised $10,000 due 1 year from now when interest rates are at 5%. Your investment in today's dollars is 9,523.81. Can we go back to the Excel? All right, now, and then put the, excellent. Okay, and then click on the, okay. All right, so the present value function, again, it's looking for the rate, it's looking for the number of periods, and in this case, the future value has to be entered as a negative. You got to watch this. That's why tonight when you're doing your work, make sure you refer to the cheat sheet. Otherwise,
we're doing present value in this too. Do you get to put in as a negative?
Yes. In this case, yes. There's going to be a couple of cases in a few minutes where the future value is positive when you're solving for rate and period. And talk to Bill Gates. I didn't make this up. All right. All right. So if you click on OK, then that's the number that we have in the text. Okay. All right. Now, okay. Now, here's now another use of this is it says the net present value of an investment is the present value of the expected cash flows. Now they're keeping this real simple. It's the expected cash flow less the cost of the investment. So suppose an investment that promises to pay $10,000 in 1 year is offered for sale for $9,500, and our rate, the rate that we want, is 5%. Okay, should we buy it? Now, keep in mind we just calculated that the present value of the $10,000 was like, well, in fact, I can go back to it, was $95,2381. Okay. Now, picture yourself, you're at your insurance broker, and he's trying to sell you something, and sometimes these guys are just like car dealers. You ever notice when you go to buy a car, they never tell you what the rate is. They never tell you what they're giving you for the trade-in. They only tell you what the monthly payment is. And they figure, well, if you can make the monthly payment, you'll buy it, even if you're paying an interest rate that's 2 points above. Okay, all right, so we've all been there. And now I know some of these insurance people, they're crooks. They're saying, look, yeah, you give me $9,500 and I'll get you 10 grand. And you go, oh, isn't that wonderful? Well, the reality is that if your investment, if your desired rate is 5%, and you're paying $9,500, well, in this case, the present value of the cash inflow is greater than the cost. In other words, the net present value is positive, so this is a good deal. In other words, we're actually doing a little better than what we want. Okay. Now, in a future chapter, what we're going to do to value a capital investment, we're going to take the cash flows provided in the future, discount them to today, and compare it with the cost of the investment. Tonight, we're keeping it simple. We're saying we're just dealing with one period. Okay? All right. All right, so is there any questions so far? Everybody comfortable? So we've done two functions, present value and future value. Okay, and again, there's a cheat sheet that's out there. So and inside the Excel cells, you know, it's not just the answers, there's the formulas in it. I should say the functions. Okay, so please make use of it. All right, now again, when it says in a one period case, the formula for net present value is simply the present value of the cash inflows minus the cost. If we had not undertaken the positive NPV project considered on the last slide, and instead invested our $9,500 elsewhere at 5%, our future value would be less than $10,000. Okay, so here they're saying $9,500 invested for a year at 5% would have only yielded $99.75. So actually, what we were being offered was a good deal. All right, now simple interest is where we invest money and then every year we take out the interest. Okay? All right? So each year you invest 1,009%. You get your $90 and then you take it out of the bank, or you take it out. So every year you earn the $90, but your money never grows because you're always taking the 90 out. Now that's simple interest, okay, which we will not be doing in this class. We're going to be using compound interest, where the presumption is that money earned stays in the investment. So we're not only earning interest on our principal, but on the interest that we earn. Okay? Okay. All right, and that's compounding. All right, so okay. Now again, you can do this in Excel, where I had the future value as being one period, but if we're dealing with more than one period, that's what the T represents. All right, so we can leave the future value of an investment left on deposit for multiple periods. You can calculate the value of that, and the presumption is that you're not only earning interest on your initial investment, you're earning interest every year on the interest that you're earning. Okay. All right, now, whoops, okay. What this is saying is, suppose stock currently pays a dividend of $1.10, which is expected to grow at 40% a year for the next 5 years. So the question then is, what will the dividend be in 5 years? And we calculate that by saying $1.10, earning 40% for 5 years. Can we go back to the Excel map? All right, so put the cursor on the 592 and then hit the function. So I said the rate is 40%. That's pretty good. I don't know how many companies increase their dividends by 40% a year, but let's go with it. So I input the rate. It's 40%, so it's 0.4. All right. Earlier, when we were dealing with 5%, it was 0.05. The number of periods is 5. The present value was $1.10, but I put it in as a negative. So we hit OK, and there's our 592. All right, everybody good? Okay. All right, if we could go back to the. You know, Matt, I'm almost thinking, because I have to keep rolling forward, why don't we just, well, I get all the slides then. If we just make it, we just do the full screen for that, I lose the slideshow.
Yeah.
Okay, all right, let's go back to the slideshow. All right, so I've got. All right, it says, notice the dividend in year 5 is considerably higher than simply 5 times, well, it's not that higher, but it's higher than $5.50. All right, and that's because we're earning interest on the interest, or on the increase, okay? All right. All right, now I left this in here because what's really happening is the $1.10, the $1.10 times 140 is 154 after 1 year, but then the next year, the 154 times 1.4, and then 216 times 1.4. This is the effect of compounding. All right. All right. I mean, that's what's going on. We're earning money on our earnings, on our previous year's earnings. All right. Now you can do the same thing with multiple periods with present value, and that's what we'll be doing for bonds tonight and for capital investments in the future. All right, so the present value equals some value to be received out in the future divided by 1 plus the interest rate raised to the power of the number of periods. Okay, so the example here is what's the value of $20,000 to be received 5 years from now if the interest rate is 15% a year? All right. In other words, what we're doing is we're taking this $20,000 and we're bringing it back 5 years. Okay. All right. Matt, could you? Okay. All right. So. What I did then is we have, it's looking, the arguments are the rate, 0.15, 15%, the number of periods is 5, and the future value is 20,000. Okay, so you hit OK, and that's our 99.4353. So $20,000 to be received 5 years from now, when the rates are 15%, is really only 99.43. Okay, now all right, now, in Excel, you can solve for not only present value and future value, you can solve for the number of periods and the rate. Okay? All right, so now, if you read your textbook, it tells you that. All right, Matt, can we go back to the slides again? I just want to.
You want to go to Excel?
Yes, please. All right, you can solve, if there's a function in Excel called nper, all right? In other words, what this is saying is that, could you put the cursor over the under period? All right, and then hit the function. In other words, what this is looking for is that if my interest rate is 10%, and I wanted to invest $5,000, how long would it take that 5,000 to grow to 10,000? All right, again, under the function, there's a function called nper. And what we're solving for is the number of periods. So the argument, it looks for the rate, we're assuming a 10% rate. We're saying that the initial investment is $5,000, so you enter it as a negative. And then we want it to grow to 10,000. So how long would it take for that to happen? And what this is telling us is that it'll take 7.25 years. Okay, now that might come in handy at the, I mean, you know, I think these are useful. All right. Now, Matt, could you put the cursor over rate? No, on the next line, on line 20. Okay. All right. Now, another thing that's in Excel, and I would think this would be useful also, is that you know, somebody, and again, this goes to my argument about you're being sold a financial product, and they want you to put so much in today, and they tell you at the end of a period of time, it'll be worth X. But the question is what are you really getting? All right. So you're leaving the money. First of all, you're investing $5,000. So you put a negative $5,000 in. They're telling you at the end of 12 years it's going to be worth $50,000. So, and what you're solving for here is what's the rate that you're actually earning on that $5,000. Okay, and the rate is 21.15. So I mean, these are obviously this text was not written with the current rate structure that we have, but I think this is a good tool. Okay, all right. Can we go back to the? All right. All right, now, what happens if we have multiple cash flows of different sizes, all right? So far we've been dealing with present value and future value of single amounts. What happens when we have a cash flow stream that is different? And what this is saying is that we're going to invest $200 and we're going to increase it by $200 a year for 4 years. Our desired rate is 12%, and again, this investment is going to pay us $200 after the first year, $400, etc. Okay, and the person selling us this wants us to pay $1,500. All right. Now, I'll get to the end of the story. The present value of this stream is $1,432.93, so paying $1,500 for it is not worth it. Could you go to the Excel? Now, in Excel, there's a function, and we will be using this when we do the capital investments. All right? And it's called the net present value function. And what you do is you list the cash flows in the order that you're receiving them. That's important. All right? You have to list them in the order that you're receiving them. Could you put the cursor over 1432.93? All right, and then hit the function. All right, now what this in Excel it's called NPV. All right. Now, there's a little bit of a misnomer because what it's really giving you is the present value of a series of unequal payments. All right? And the arguments, it's looking for the rate, and it's looking for the cash flows starting with the earliest year and going to the latest year. Okay, everybody good? Again, the function is NPV. All right? then if you do that and then click OK, that's our 1432.93. By the way, on the go line tonight, this is the formula that you'll be using. Okay? All right, you'll be solving for the rate. All right, and for those of you that I changed the go live first question because I had difficulty figuring it out. Okay. All right. Okay. Can we go back to the slide? Yeah. No, we would have been here all night. We'd have been here tomorrow for breakfast. So. All right. And at the end of the day, I didn't think it was as appropriate as learning how to solve for the rate. I'm sorry about having to jump back and forth, but I think teaching you where these things are is important. Okay. All right, now, in Excel, there's, because things like mortgages, all right, there's a flat rate. However, because payments are made monthly, the effective annual rate's a little higher. All right, now, and in Excel, there's a way to calculate that. But I think I'm going to not. It's on the cheat sheet, and what I do is, and one of the reasons I showed you how to do it is because I think that's something you want to know. And the other thing I wanted to talk about, when we do the chapter on bonds, which is coming up next, when interest is paid semi-annually, you have the rate and double the periods. Okay, maybe that's something you know, but okay. All right, I'm going to skip by this. All right, now. I'm going to blow by this pretty quickly. First of all, when we do the cost of preferred stock, which is next week, an investment in preferred stock is considered a perpetuity because it pays a constant dividend forever. I mean, the assumption is that if you held on to the stock forever, that's a perpetuity. An annuity is a constant cash flow that lasts for a fixed number of periods. Now, when we get into bonds, coming up in a few minutes, the redemption value, the maturity value of the bond at the end of the bond's life, we calculate the present value of that as the present value of a single amount. The semi-annual interest payments are actually an annuity, and we solve for the present value of an annuity, and I'll show you how to do that when we get to the bonds. All right. So, in other words, the value of a preferred stock is the dividend. Is the dividend divided by the dividend rate. Okay. That's how you get the present value of preferred stock. All right. Here there's so in other words, if I had a preferred stock that paid 15, don't ask me why they use pounds. And if the dividend was $15 a year and the dividend rate was 0.10, then the value of that preferred stock would be 150 pounds. Okay. All right, now, again, an annuity, this is where, like with a bond, you get a constant dividend a constant interest payment every 6 months. So that's an annuity. All right, and I'll show you how to do this in a minute. All right, now one thing I wanted to point out, and this will help you in the go live. When somebody gets a pension, okay, now this is not set up for that, but what a pension really is, or a defined benefit plan, is they have to put money away so that when the employee retires, there's enough money to pay a constant amount until the employee dies, okay? Now, to calculate the value of the liability, you first of all, you go to an actuarial table and determine how long after age 65 the employee will live. So you take a present value of that payment stream, okay, which is, you know, let's say you're 20, you're going to retire at 65, so 45 years from now, I have to have an amount that will enable me to pay a certain amount every year. So to determine the liability for that, I have to bring that series of payments back to year 65 and then take that lump sum and take the present value of the single amount back to age 20. Okay? All right. All right, now, all right, can we go to the next? What time? It's 6:40 right now. All right, well, I gotta do this. You guys been doing the go lives pretty quickly, so all right, now what's important about this is that one of the requirements that you're supposed to do for your project is to determine the cost of debt. And the cost of debt is really the yield to maturity. In other words, what's the debt selling for today? And how can I determine what that yield to maturity is? What's the cost of that debt? All right. Now, I know some of you are very familiar with this. We're going to do stocks next week. What makes bonds different from stocks? Well, first of all, the bond promises to pay you back. Stocks do not. If I buy a bond, I'm promised to get, in the U.S., bonds are usually valued at $1,000. I buy the bond today, I get $1,000 back, 10, 30. Walt Disney is selling bonds with a 100-year life. True story, true. They call them Sleeping Beauty bonds. I'm serious.
Do you have one?
Do I own one? No, I'm not going to live on it. All right. Now, so there's a stated maturity value, $1,000. There's a coupon rate, which is a promised interest rate. Okay, and in the catacombs of Wall Street, there's multitudes of analysts trying to determine what the proper coupon rate is for a bond issue. However, the likelihood of the coupon rate and the market rate being identical on the issue date is remote. Interest rates are determined by wars, recessions, whatever, whereas the coupon rate is determined by the company itself, the industry that it's in, the length of the maturity. You know, there's a lot of things that go in, and a great deal is put into it, but the likelihood that the market rate and the coupon rate are going to be identical is it's like trying to hit a moving target. So that's the issue, all right? All right, and then there's, like I said, bonds are issued for a certain period of time, and when that period of time arrives, you get your money back. Okay. Now, the yield to maturity, this is what you guys have to calculate for the various bonds or debt that you have outstanding, is the required market interest rate on the bond. Okay? So that's why if I'm running over on the lecture, this is important because you have to do this to do your project. okay? And if you have multiple issues, you have to do it for each issue and then calculate a weighted rate, okay? So the coupon rate and the yield to maturity, the required market rate, are generally different, okay? All right. So when we determine the value of a bond, there's two calculations. And I set it up, I have an example, and the go live is a series of calculations, but in Excel you can simply bring it down. And what varies is the term. The interest rate, you have two issues, and the rates and the coupons stay the same, but the length of time is different for each calculation. All right, so when we value a bond, we're really doing two calculations. All right, we're going to calculate the value of the annuity, and we're going to calculate the value, the face value. Okay. All right. All right, now I'm going to kind of blow by this. Again, in the U.S., bonds pay interest semi-annually. So if I'm given an annual rate, I cut it in half, and I take the I cut the rate in half, and I double the periods. Okay. All right. Now, I've done this in Excel. So why don't we, Matt? Can we go back to Excel? All right, and then scroll down to, all right, in the first example, all right, the bond was paying, $63.75, 6.375 for 5 years, all right? So the coupon for a year is $63.75. However, the interest is paid semi-annually, okay? So, again, now, please, most textbooks teach it this way, so don't try doing shortcuts. Just, if the first thing I did, if we go up to the 269.32, what I did was I said the semi-annual rate, in other words, this number divided in half, is 3.1875 or 0.031875. The number of periods I doubled from 5 to 10, and the payment. This is how you do an annuity. The payment is the 31,875. Okay. So we click OK, and this is the present value of the earnings stream, or the interest payments.
So the payment is now in semi-annual payments, right?
Right, yes, yes. All right, and then if I click on present value up here, on the 730.68, now I'm saying the present value of the maturity value, the $1,000 I'm going to get at the end of the bond's life, I put in a negative 1,000, there's my 10 periods, and there's my semi-annual rate. Okay? All right, now, because the bond is selling at par, in other words, the market, the yield to maturity is equal to the coupon, the bonds sell at face value. Okay? Now, in the second example, the bonds are selling at a premium. In other words, the coupon is 6.375. The market only requires 5%. All right, so when my coupon is greater than the required rate, the bonds sell at a premium. In other words, they sell at an amount greater than the face value. Now, again, you're saying, well, why can't you just go to the bond indenture and cross out the interest rate and put in the market rate? Well, I'm being facetious. You can't do that. Okay? Bond issues are not something that you wake up as the CEO on Monday and say, I'm going to do 100 million in bonds by Friday. That's not how it happens. You have to go to an underwriter. You have to bring in the legal folks, the SEC, the accountants. You have to print out prospectuses. It takes months. My claim to fame is when Niagara Mohawk bought out the independent power producers, they did a $3.85 billion bond issue, the largest junk bond issue ever offered by a public utility and the third largest junk bond issue ever. It took 2 years to put it together. It dealt with Donaldson, Lufkin, and Jen Brett down in New York. They're underwriting. Again, and a great deal of effort went into determining the coupon and everything, but again, on the day the bonds were issued, they went off at a discount. Okay, so now when the rate is, I got a typo here, I'll have to fix that. Not the sterling, it's the selling. All right, now the required rate is 11%, which is greater than the 6.375, so the bonds will sell at a discount. And once again, if you put the cursor over the 240, again, the arguments it's looking for is the semi-annual. Oh, yeah, all right, this is very important. What drives the bus here is the yield to maturity. Okay, the coupon payment stays the same, but what drives the bus, this rate that you're putting in, is the yield to maturity. Okay, all right? Okay, so if I click OK, then this is the present value of the interest, and then if I go down here to the, all right, I put in the -1,000. Again, the number of periods is 10. And again, I get the semi-annual yield to maturity. Okay. Now, the last thing I want to do, by the way, it's getting late. There's a lot of good soft material at the end of the slides. In other words, they go into, they talk about various types of bonds, convertible, callable. It's nice to know information. Okay, so please, if we have more time, I'd gladly talk about it. All right, now, what happens, could you scroll down just a touch? Yeah, okay, now, what if you're trying to calculate the rate? All right, now, in your textbooks, they talk about yield, all right? And they even demonstrate how to do it. But I would recommend you don't use the yield function, you use the rate function, okay? You have to it works on the issue date and the retirement date. And when I say date, I mean like 1/1/17 and 12/31/30. And if you screw that up, you get a funky answer. Okay? So, if could you put the cursor on the 11%? Yeah. Okay. And then go up to function. All right. Now, what the argument it's looking for, I'm trying to find the yield to maturity of a bond that's currently selling for 928.06. So that goes in as a negative. The coupon is 100. That goes in as a positive, and the future value goes in as a positive. So here's what's going to happen. You're going to look up the various issues of your the company you've chosen, and you're going to look up what the bonds are currently selling for. And the redemption value is always going to be $1,000 a bond. You're going to look for how many periods is the bond outstanding for. Not the original amount, but how much longer is the bond going to be outstanding. And then the rate you solve for is your yield to maturity. Okay? All right. Now, but bonds are sold, you click OK. All right. But however, what if it's a semi-annual rate? All right. So what I have to do then is if interest is paid semi-annually, all right, I have to double the periods and have the coupon. All right. But again, the coupon, the interest payments are entered as a positive. The current selling price is entered as a negative, and the redemption value is entered as a positive. All right. And if I click OK, that gives me an interest rate. However, it's a semi-annual rate. So you have to multiply by 2 to get the annual. All right, now again, this cheat sheet is up in Engage. All right, now believe me, I wish I could talk about bonds a lot longer. But again, what you're going to be doing in the Go Live, you're going to use these formulas right here. All right, in fact, you could cut and paste for all I care. All right, but it's the guts of it. You got to know the rate. You got to know the coupon. All right, and then you're going to use the rate formula from up above. Okay. All right. Why don't we break out into our Go Lives then? One of the things that I want to point out, when you're using the present value and future value payments to calculate the value of the bond, when you use those functions, the coupons go in the payment, and the retirement value or the maturity value of the bond goes in future value. Okay. The other thing I wanted to point out, and this is just nice knowledge. All right. If you did it, and most of the groups I popped in on did it. As you look at your work, the further out in time you go, more of the value of the bond comes from the coupon payment, and less comes from the maturity value. Okay, if you look at it. Now, again, we have some bankers in here and other people that they work in the finance industry. The buzzword is duration. Okay, the longer the maturity value of your bond mutual fund, the greater, the more sensitive it is to interest rate changes. Okay, the shorter the time or the shorter the duration, more of the value is coming from the maturity value of the bond itself, less from the interest. So bond portfolios with a shorter duration are less sensitive to interest rate changes. Okay, that's just good to know. All right, now, again, for your project, when I ask you to calculate the cost of debt, you have to literally take each one of your debt issues, calculate the yield to maturity, and then take a weighted average based on the number of issues you have in the various yield to maturities. Okay, now, that's not easy, but in Excel, it certainly makes it easier. And the only thing I ask is, if you get a ridiculous number, Like you get, oh, my cost of debt is 240%. Call me. All right, because that's not, in other words, if your average coupon rate is somewhere in the neighborhood of 7.5%, then your cost of debt can't be 240%. So you've done something wrong, okay? So just be aware of that. Don't just say, well, the computer did it, okay? All right, look, I thank you for your attention tonight. This night was not easy, but it certainly was important going forward. So I'll see everybody next week, and I promise it'll be easier.